Control accounts, period. A control account is any account that brings together all of the ledger entries that affect a given accounting group. So you can have a sales control, a purchase control, an inventory control, a cash control. You can have a control on anything as long as it has enough information for the control. So it acts as a double entry to the subsidiary ledgers whose information is being transferred to the general ledger, obviously to find that particular account. Now businesses mainly use control accounts for a lot of different reasons, but these are the 4 key ones that we use. One is to check the arithmetical accuracy of the postings. So remember, double entry says for every debit you must have a corresponding credit. So you want that the sum of all your debits be equal to the sum of all your credits. So you're going to test to ensure that everything, all the numbers are mathematically posted for the arithmetic accuracy. Then you want to be able to do a quick summary of the account balances. So you want to be able to know quickly what's the total amount that debtors owe you, or the total amount that you owe your creditors, or how much money you actually have available to spend, something like that. Alright, thirdly, they be used to detect and or prevent errors or fraud in those specific areas. Because you want to be able to quickly identify whether, say, the staff is taking home stock, or somebody is taking away some of the cash, etc. Right? You need to be able to control these things. And fourthly, the one is that you want to make a key financial report at the end of a short period. So therefore, the control account will be very useful for making those key reports. Alright, there are several types of controls, as I would have just identified, but the 2 most important ones we're going to look at today are the sales ledger control and the purchase ledger control. Now these are the alternative names. You have a total debtors control, which is the same as the sales ledger control, and a total creditors control, which is the same as the purchase ledgers control. Alright, so let's look at these 2 control accounts. We start with the sales ledger here on my list. Sales ledger control, this is a summary of all the activities of the individual accounts of the credit customers found in your sales ledger. So you would expect then that the balance at the end of this control account, which is the total debtors, should be the same as the sum of the individual balances of each customer found on your sales ledger. That's why it's called a control. See, you're ensuring that what you say one place is really so when I do it somewhere else. Similarly, the purchase ledger then would be a summary of all the activities of the found from the supplier's side, and these are in the purchase ledger. Therefore, again, we would expect that the balance in this account, which is our total creditors, will be the same as the balance of the individual, same as the total of all the individual balances on these credit suppliers' accounts, which will be found in the purchase ledger. So, if we sort of break this down now a little smaller so we can see, okay, what information are we talking about? What accounts are we referring to, and where does this information come from? So we know then, for the sales ledger, the data on the activities of all the individual accounts of the customers will be posted in the sales ledger from several books of original entry. I'm sure you know your books of original entry. You have your sales journal, your purchase journal, your cash book, your returns inward journal, your returns outward journal, right? You got your 5 or 6 journals, and of course there's the general journal. Now, so let's see where we're getting our information from. So one source is the sales journal. This will have all of the credit sales that you recorded during the period. So obviously, credit sales means that you have credit customers. So the sales journal will show you the names of all those credit customers and what they have purchased, right? In other words, what you sold them. Then you have the sales returns journal, or what we call the returns in return, right? And this is where these customers who have bought goods from you on credit have also, they weren't satisfied with what they got. In some cases, they were damaged or the wrong color, etc. So they returned some of them. So that information obviously affects these debtors, hence the sales journal. And then the cash book, where you will find receipts of cash and checks and other discounts that you may have offered these customers. And then there's the general journal, where you would have things like where you wrote off the bad debts or you recovered bad debts, if you were charged interest or you charged interest, and if there were any set-offs. All right? And the purchase ledger, that data, right, would also be posted in the purchases ledger. And the books of original entry that you will get this information from, let's see, you'll get it from the purchase journal, right? That's where you find all your credit purchases, hence your suppliers. And then you could get it from your purchases returns journal, because you may have also returned some goods to the suppliers because they were the wrong color or they were damaged or whatever the case may be. Then the cash book, where you would have made payments to your suppliers and they gave you discounts. For example, you got discounts received. And the general journal, where the suppliers would have charged you for not paying your accounts on time, or you may have had some setups. So you can see clearly the books of original entry where the information is gathered from. So if we were to break these down then, so let's look at them individually. So let's start with the sales ledger control. Now remember, this comprises of all the data that affects the relationship between the business and the credit customers. All right, those people that you sold your goods to on credit. And basically, you're looking at the data that increases how much the customers owe the business, minus the data that reduces how much the customers owe the business. And that will give you the amount the debtors owe you. Okay? So it is how much, what information increases their balances, minus the information that decreases their balance in order to get their actual balance. Good. So let's look at what can increase the sales ledger balance. Okay, we got credit sales, that will increase it. Refunds made to the customers, because what would happen is that a customer have paid for the goods but then returned a couple of them because something went wrong with them. So you got to refund them. Then you have interest charge on overdue accounts. In this case, the customers were supposed to pay you, say, last month, but they haven't paid, so you have put on some interest on that debt. Then you have bad debts reinstated. So what happens here is that these customers, you might have written them off some time ago because they wouldn't pay you at all. But then, time has passed and they've got themselves together and they come back to you and say, we want to restart business. And you say to them, well, you've got to sell your debts first. So you will reinstate the debt and hopefully they'll pay. But notice when you reinstate the debt, it will increase the amount owed to you. And of course, you have dishonor checks. In this case, obviously, the customer pay you by check, but when you went to the bank, there's no money. So therefore, you still have that balance. It did not decrease. Now, on the other hand, what about those things that decrease this balance? All right, so let's see. Now, if the customers pay, right, whether by cash or check, so the receipts that you find from your cash book, if they pay you, then that reduces the balance, right? Because if I owe you $100 and I pay you $50, then my balance is now $50. Then you have the sales returns. So if I have bought $100 in goods, but I return $20 worth, then obviously my balance can't be $100 anymore. It will have to be $80. And then there are discounts allowed. So let's say I owe you $100, but you want the money, so you say to me that just give me $80 and we call the debt settled. Then that means that the $20 that you allowed me not to pay is the discount. Hence, that reduces the balance. Then you have bad debts written off. So remember here now, I owe you $100 by making no effort whatsoever to pay you. So 2-3 years pass and you still can't get a cent out of me. You went to the court, you do everything. You tell yourself, you know what, I'm going to write this debt off my books because I'm tired of paying the tax man this extra money. So you write it out of the books, right? However, notice the next item says recovered bad debts paid. Now, so let's say 3-4 years down the road, I get myself into a good position. I come back to you and say, well, you know, I really want to get back into business. And you say, well, you got to pay that debt. So you reinstated the debt, as we said earlier, but now I still got to pay the money. So once I pay the money on that recovered debt, I would have reduced the debt. And then the last one is something called a set off or counter purchase. In this case, obviously, I buy from you and you buy from me. So if I owe you $100 and you owe me $100, I mean, it makes no sense I bring $100 down to you for you to give me a back and go back home. So we would just make an agreement to cancel it on the books. So hence it's called a set off. We set off the debt against, in this case, against the purchases. Alright, so the increases minus the decreases will give us the balance due. Alright, so let's quickly look at it from the purchases angle. So again, we have the data that increases the amount the business owes the suppliers minus the amount that reduces how much the business owes the suppliers will give us the amount due from the, obviously not the debtors receivable, the amount due from the creditors or payables. So what then increases the purchases, the balance? So we have credit purchases. That will increase the amount owed to the suppliers if we buy some more goods. Now if the suppliers refund us because we overpaid, then that would send back at the balance, right? Because they would have thought that we paid, but we didn't. Increased charges due to overdue accounts. Now, if they charge me for not paying on time, that would also send up my balance. And similarly, if I write a check but I ain't got no money, then technically I haven't paid them either. So therefore, that would drive up the balance. Or at least the balance does not go down. But what reduces the balance? So, payments. Now if I make a payment though by cash or by check to my supplier, that reduces my balance. Similarly, if I return goods or I receive a discount or again set it off against the sales, that would reduce my balance. So there you go. That is basically controls account in theory. Just want to thank you and keep